Okay guys, it's Winter again. So this is part 2. So let's continue with the lesson. So this is the lesson part 2. So let's quickly jump into it and see what can we do to learn about this thing, right? But other than that, this is the structure that we're going to be learning about. So now remember the first video clip, it was all about the introduction of what to expect. So now let's jump into this, and then let me just quickly explain to you what is this order block that we are talking about and what is it capable of doing, right? So for now, let's quickly jump into it. I'm going to explain to you everything now, so that we can be able to understand what's happening. Okay. Let's just quickly get into this single page, this one over here, and then cool. Don't worry about the trademark at the back. It's just for security reasons, so that you, like I said, if you are looking for this PDF, contact us, and then we will be able to provide you with the real copy. This is just for protecting the whole thing. We're just protecting it, but for our clients, they have the original copy of this. So if you're looking to get the original copy, so you will contact us, then we'll take it from there. So first thing first, what is an order block? What are the order blocks? What are these things that we are looking for in the market? So basically, when we're talking about the market, so institutional money enters the market algorithmically at key levels in which that it increments known as order block. So institutional money enters the market algorithmically at key levels in increments known as order blocks, right? So rather than entering hundreds, look, this is what the guys they do, they're the big boys. Rather than entering hundreds of millions in currency into the market at once, the institutional order blocks are broken into multiple entries, creating tight consolidations that we see right before an impulsive movement in the market. This method leaves an institutional footprint on a chart that can be identified and capitalized upon. So once you know that these guys, what do? So whenever they jump into the market, you'll see someone might be asking, like, how do we see that the big boss have just jumped into the market? Now, what we basically mean is that, what do you see whenever they jump into the market? There you will see a very huge like candlestick. Whenever they jump in, you will see like a huge candlestick going upside or a huge candlestick going downwards. So that's when you know that now this is something that is not happening, or this is something that the big boys have just jumped in. Okay, cool. Let me just quickly, we're going to be done with the theory. I'm going to just quickly explain everything to you, so that by the time you jump into the examples, you already know what it is likely to be happen. So once you'll be able to understand, or once you start seeing that this is how they jump into the market, there will be a huge big candlestick, or there will be a huge like something like that will make you see that now there's a lot of volume into the market. Just know that that's when the big boys, they've just jumped into the market. First of all, they will just start by creating consolidation. Once they start creating consolidation, this is where now these guys, they just breaking down their orders. They don't just want to put them all at once. They just create consolidation. They're building up liquidity. Then after that, that's when they will just create an impulsive move. Remember, the market moves like in impulse correction movement, right? Cool. So we will get on that one. The most important thing to understand about these institutional orders is that there is no protective stop loss being used. So these guys, they don't use the stop loss. The reason for this is because institutional hedge their positions, right? Someone might be asking, why will they do something like that instead? So they buy and sell simultaneously, like they buy at the very same time. You may be wondering, why will they do that instead of just using a stop loss? The answer is very simple to that question, guys. The answer is very simple. Institutions move the market, they do not lose. Whether they buy, they sell at the very same time, these guys, they don't lose. So remember, these guys, there's a lot of volume, there's a lot of liquidity. We are the liquidity, and they also have like big bucks. They've got a huge amount of money that they're trading into the market. So basically what's happening here is just that these guys, they break their, like if they've got like 100 orders they want to place in, they won't just put all 100 orders at once. No, they'll break them down like until all their orders that are being filled, until they move to the direction where they want to move, right? Cool. Let's say a short position and a long position are taken at the very same time at key levels. These key levels, we as the retail traders, we name them your highest high or your support on resistance. Those are the things that, like supply and demand, those things, we call them those. But these ones, they've got like, they place like, let's say let's say a short position and long position are taken at the same time at a key level in the market. Market momentum dictates price to move higher in favor of the long position. So let's say they put that, or they enter the trades same time simultaneously, they sell and the buying order at the very same time, right? Only to find that the market start moving into the long direction, right? Once that will be favoring the long position, that will still leaves an unattended short position in a drawdown, a massive drawdown, unrealized loss. Once the long position has reached the desired target, price must then retrace back down to the short position point of origin to mitigate the unrealized loss, right? The unrealized loss. Once the loss is mitigated, more often than not, price will then continue to in the favor of the dominant trend momentum. That's why it's always wise to wait. You can wait once there's an impulsive move, just wait for it to retrace back and then you enter when it's peaceful, especially with the events. But I will show you, I will still create a video lesson for how to trade the event. During this process of order block mitigation, retail traders are busy focusing on double tops, flags, Fibonacci, moving averages, and other indicators that have nothing to do with the why price does what it does, right? This allows institutional money to play with the retail trader and liquidate their positions in the form of stop loss, stop hands, and fake outs, and those things. So whenever you still creating like their double tops, these guys, they're busy playing with the psychological, the emotions. The truth is, this is a simply institutional algorithms doing what they were designed to do. Remember, these guys, the algorithm, it's an automated thing that, like the system that is being created to manipulate and play with your emotions. Everything that you do, it's not like the market is against you. No, it's not like that. So what I'm trying to emphasize here is just to break it down. So we're almost done with the theory part. Then we're going to be jumping into the trend line and everything and the examples. But for now, I just wanted to explain to you. Sometimes you'll be wondering or asking yourself that I've entered the trade and it went into my direction. The next thing it goes against me, and once I blow the account, the next thing that price start going like in the very same direction that I anticipated. You've been asking yourself why. That answer is right here. This is the form of like stop loss hands and fake outs. This is where they liquidate your positions. This is where they play with your emotions. They want to make sure that you don't you lose money. That's when they want to make sure that you lose money. They want to make sure you lose money in the market. Other than that, guys, we will be jumping into the next chapter, of which we're going to be doing examples. Now we're going to be looking at the examples of how to trade these order blocks. And again, thank you so much for watching this till the end. And now I believe that we are done with the theory part. We're going to be looking at the examples of order blocks. Other than that, let's jump to the next one. It's only going to be a long lesson now. It's just simple lessons, and then we're done. Then we're going to be carrying on, right? Thank you so much.